Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, I think we can start now. In this lecture workshop, we're going to go through the annual report for Woolies in very much details. My purpose is to show you how you may extract useful information from the annual report, which is publicly available. And remember this, the annual report is organized in a way and it's for the purpose of recording the economic activities of the company. So it's probably not most convenient report for us to read as an equity analyst. So that's why we need to go into the lines of the notes and the footnotes as well and try to extract the pieces of information from everywhere in the report together for us to understand the ROIC, the NOPLAT margin, and the capital investment. All of these are important financial measures we need to understand the company. So what I talk here are just examples, how you may understand the accounting item and how you may use the annual report. It doesn't mean that you should only look at these items in this workshop. It should extend to all of the accounting items in the P&L and balance sheet, and even some of the cash flow items for Woolies. So we'll start from the first page. First page of the annual reports, the content. You will find an index of where you might find all of these information. So I understand that some students may find it okay. Understanding the accounting things could be overwhelming and very challenging. They'll go straight to almost half of the annual report, just the financial information of the company. That's probably not very smart to do to understand the company or its industry as a trainee analyst. So I assume before this course you had no experience of reading a listed company annual report. You had no experience of reading through a sort of business model or corporate strategies. So the best approach is to go to read from the first page. Usually in the annual report of a listed company, you will find a summary of the company's performance in the past financial year and some highlights of its performance, and like the revenue growth rate, the margin, and the underperforming or outperforming business segments. There will be a very brief discussion. And from the first section of the annual report, you may have other information about the very significant business structure changes, like disposing any business units, merge acquisition. Sometimes they may include some important financial information, even in the introductory part of the annual report. Most importantly, to understand the current and the corporate strategies going forward in the next several years, you want to read the Chairman and CEO report. They are, it's addressed to all of the shareholders. So as equity analyst, you are supposed to have more profound understanding of the company. You start from the things that you should understand from the perspective of a shareholder of Woolies. So from the Chairman report, especially for Woolies, you will understand the corporate strategy changes in the past few years and the actual things Woolies has done so far to try to implement these corporate strategies. And going forward, there will be a discussion of the trading environment, and that may help you to do your own forecasting and having some ideas how this industry will perform in the next several years. The next section is a business review. Here you will find Australian food, drinks, that's the liquor, New Zealand food, that's very small section, and Big W hotel, and discontinued operations. So this might give you an indication of how you might forecast for Woolies by this division of business segments. Of course, it's still up to you how you're going to understand the overall business and how you might do your own trade-off of benefits and cost in terms of forecasting for the whole business or by business units division or by geographic division. It's your choice. But here you might find some indications. And you will find some important ratios, performance ratios for these business divisions as well. So they might be another way of checking your KGW performance ratio outputs to see if there's any inconsistencies. Of course, the definition of a margin is different from the KGW model margin of the operating assets, but the trend or the relative performance of Woolies will give you some indication of significant error in your own model. And also there will be some capital management discussions. You will find information about the major events in terms of financing, like issuance of corporate bonds, significant increase or decrease of bank loans and these financing activities, and the management's plan in terms of capital management in the coming years. So having an impression in terms of the capital management will help you to decide the capital structure going forward. And later on, we're going to discuss how we might come up with an estimate of the capital structure going forward. Existing may be not the target capital structure at all. And don't forget reading the material business risks. They are pretty much narrative. You won't find like the performance ratios, things like that, but it's the management's take in terms of business risk, and they can guide you to understand the company's business if you're forecasting by divisions. In each of these business segments, they actually face quite different industry dynamics and the competitive pressures. The directors' report are mostly about the corporate governance issues, like the compensation for the top executives, and you will find other information of the experience, expertise of the executive managers and the executive directors as well. They might be part of your assessment of the company's performance, and but of course these might be less important than what you read about the corporate strategy and financial information. But for some companies, especially for highly competitive food retailing, and we have Coles and Woolworths, these two large players in the market, the management might make a difference in terms of corporate performance going forward. And they did have some changes with their management in the past few years. There might be some new changes of their board and the top executives. So you may have a read and have some understanding of the company's personnel changes going forward. Section 4 is about the financial information of the company. That's probably you're going to spend a few weeks to read multiple times, if it's not a dozen of times. In this workshop, I will show you how you may understand the financial report in the annual report. So I'll leave you to read the first 3 sections, And next week in the workshop, I would like to have a few groups to contribute to the discussion of your decision of forecasting. It's a division of business segments or division of geographic location, and your understanding of the business, the industry. My purpose of having this kind of workshop is to try to push some groups who are late, either late in enrollment or late forming groups, to have a good start. So I know several groups have started their entering the historical accounts, so you don't need to worry about this. Mainly next week, I will ask the groups formed by randomly allocated members to contribute to the discussion of the company's business model, the corporate strategy, and the industry dynamics. Of course, the contribution from all members of the class are welcome. This is just a tactic from my side in terms of teaching. In the last part of several pages of the report, you'll find the top shareholders of Woolies. Usually that's not a significant issue for Australian listed companies, especially for Woolies. There's no such controlling shareholder holding like 30 or 50% of the company, and that will not be a significant issue to consider in valuation. But it's good to go through the last several pages, have a look at their shareholders, the top 20 shareholders, and the five-year summary as well, to give you some impression of how the company has performed in the past 5 years. August is the reporting season. You will see a lot of companies reporting in August. So if you are interested, especially for students who are keen to work in finance in the future, I really want you to read in the next several weeks Australian Financial Review. There will be large quantity of analysis of company performance, the corporate strategies, and you're going to learn a lot, not just the vocabulary, how the business operates and the industry structure and how the economy is performing overall. They're going to help you a lot in understanding valuation, and not just for this course, for the future like job interview as well. That's going to be the reading on top of all of the required reading for this course, which is already quite heavy. Okay, so this is the structure of typical annual report of a listed company. Now we're going to go to focus on the financial performance of the company. We'll start from the P&L. That's where you'll find the income, expense, and other charges of the company. At the end, you will see. Let's make it larger. At the end, you will have the profit loss attributable to equity holders of the parent entity. That's the income attributable to shareholders of Woolies. So you will see that item, non-controlling interest, that's not attributable to the shareholders of Woolies. So we'll talk about this item at the end. But for you to understand the profit of the company from valuation perspective, that's the profit of the company for the financial year 2017, $1.5 billion. So it's probably one of the largest companies in Australian equity market. You will see 2017 data reported next to 2016 data. So for you to enter or extract the relevant accounting performance into the KGW model, you want to focus on this column for 2017 entry. So if there's any discontinued operation like this one, $111 million of profit from discontinued operation in 2017. That's the audited results for financial year 2017. If you're going to read the financial report in 2016, you will see a quite different number from this $3 billion of results from the discontinued operation. Because in the 2017 annual report, that column is for comparison purpose only. This is not audited, this is adjusted by Woolies, so that shareholders can understand, okay, when I report this income, it does not include any income from the discontinued operation. And these numbers are comparable. Of course, in 2016, the discontinued operation was not disposed. The reported audited number of revenue for 2016 will be different from this one. So for 2017 data to enter into KGW model, use numbers in this column. For 2016, you need to go to read the financial year 2016 annual report to get the P&L items to enter into your KGW model. And as I have reminded you, always work from the annual report item, like the items here, towards the KGW model. Because not all of the items from your KGW models are relevant or applicable for valuation of Woolies. So we'll go through these items in very much details to show you how you may use this number, cut it, sum it up, or do some your own manipulation and enter the correct, accurate number into your KGW model. We'll start from the revenue. You may find the notes on Wado, so I'll go through this one by one. The continuing operations, that doesn't mean it's operating results. So you have to go to read the notes, although there's no number here, but you will find relevant information from either the first several sections of the summary performance of the company or from the segment reporting of the company for the composition of the revenue here to decide if this revenue is operating or non-operating. So that's revenue from the sale of goods and services, although from the term of as it's recorded by the accountant, it looks like the sale of goods and service. It's the operating assets. But make sure you go to read the notes. It's not necessarily operating for valuation purpose. And other operating revenue, that doesn't mean it's operating for the KGW model. So go to read the segment reporting and decide how much of these revenues are operating. Any income from discontinued operations will be non-operating. Any income from disposing assets, no matter it's property, no matter it's like a warehouse or equipment or business units, they are not operating. Cost of sales. Woolies does not provide a detailed structure of the cost. On top of that cost of sales, you will see branch expenses, administration expenses. So probably that cost of sales will be most likely as the cost of goods sold. And if you look at the number, close to $40 billion and the revenue of $55 billion. So that's probably most likely to be cost of goods sold. And other expenses, branch and administration, they may cover all of the sales, marketing, personnel, and sometimes overhead expenses. So this are very likely to be operating expenses. But there might be some complications we'll have a look at. Just for now, we assume these are operating cost. And next one, financing cost. Let's look at the notes. Can't remember the pages now. Just make it 75. Okay. In note 2.2, you will find more information about the financing cost. Different companies, depending on the nature of their business, the financing cost can be quite different. So you need to go to read the notes and try to understand the structure of the financing cost, what's included there, and what's the reduction of the financing cost, especially the capitalized interest. So you will hear there's total of $193 million of financing cost. Now we need to decide if any of these costs are operating or non-operating. And then, because for the valuation purpose, we need a good estimate of interest expense for some very important debt servicing ratios and performance ratios. So here we have a few items of interest expense, interest capitalized, that's a reduction of interest expense. So most likely the interest expense of $231 million will be the cash interest the company has paid over the financial year. But on their book, the accountant decided, okay, of that $231 million of interest we paid, that's negative cash flow, we can capitalize $29.9 million. Of course, there's others. Read the notes, includes interest income and dividend income. So we have, under the item of financing cost, we have three things, and we have to decide the nature of each of the item to enter into the KGW model. So obviously, interest expense should go straight into the KGW model as interest expense. Of course, before doing so, you need to read about the debt, corporate bonds, the bank loans, read about the notes about these debt, and to decide if that will reconcile to the interest expense reported by the capital management segments of the annual report. But for now, this is interest expense. This will go into your KGW model. Line 20, that's interest expense. Okay, the next item, interest capitalized. So interest capitalized are the interest the company paid before the warehouse or the equipment or the shop is ready for operation, ready for business. So they may take a bank loan to finance for instance, the purchase of a warehouse. So they need to make modification of the warehouse so that it can be used by the retail industry, given that it was used by some manufacturing factories. So before the warehouse remodification is completed, any interest accrued before that date will be capitalized. This value will go into the value of the book value of the warehouse on the P&L. So that will be recorded as addition on the P&L. If you go to read the notes of the PPE of the company, you will see reduction, amortization, depreciation, and addition as well. And this will go to the addition part of the fixed assets of the company. So that $29.9 million of capitalized interest will be either depreciated or amortized with other fixed assets investment. That's the record of the accountant. So For valuation purpose, that capitalized interest will be recorded as fixed asset investment. So this will be included as part of the CapEx. And for our valuation to come up with a correct estimate of interest expense, this will not be necessary. We do not do what the accountant has done to reduce the interest we pay. This is the interest, the negative cash flow the company has paid. And we're going to ignore that to come up with an interest expense or interest income. Instead, this will be included on P&L or CapEx of the company. The $8 million is a very small number. I know you might have the argument that for a company like $55 billion of revenue, this $8 million is nothing, and it might be there's no additional benefit for us to try to find out what that $8 million will be and how we're going to input that number into KGW model. I agree that this is a very valid argument. For a company like Woolies, these number, even that $30 million, are a very small number and trivial. It will not affect our valuation or its performance measures significantly. But we're having a training, we're learning to see how things work in valuation. So I will strongly ask you to record these numbers into KGW model correctly. This is learning. I know in practice, like for a lot of the analysts of Morningstar or Macquarie Research, they won't care too much about these numbers. But as students who are learning about valuation, you should do this. And also with capitalized operating lease, and later on we'll come with a few very small items in number, but they provide us a learning opportunity. So even it's a very small number, I still want to talk about how this will go into a KGW model, because in the future you probably will have to value another company with huge numbers of this, very high significance, and they will be essential or critical for your valuation, for your understanding of the company performance. So with that $8 million of interest income and dividend income, is this operating? Is interest income or dividend income operating for Woolies? No, it's not operating revenue. So that $8 million will go into the KGW model, line 18, non-operating income. So now you might have the question now, okay, for the financing cost, we divide it into 3 components, and we booked interest expense, non-operating income, and it's not reflected. The capitalized interest is not reflected in any of these items for now. If you go through like this, and you're going to have a different net income number from what's the profit reported from the P&L, because the capitalized interest is not booked anywhere in the P&L yet. So let's think about the cost. Let's go back to the operating cost of the company from another perspective. So we have operating revenue, non-operating revenue, operating cost, non-operating cost. That's probably the interest income, interest expense. And then we have a net number of profit attributable to the shareholders of Woolies. So given the profit attributable to the shareholders of Woolies, where you can use as a referencing point, that's the end result you're going to have even after entering all of the items in KGW model, and that end result should be the same as the profit reported by the accountants in the P&L. So starting from there, we go backwards to work out the operating expense. Because we classify the operating expenses in a different way from the accountants. For the operating income, it might be more straightforward, especially for Woolies. You will find it's easy to find out the operating revenue, the top two, lines 7 and 8. And for now, at least from the P&L, we have identified one non-operating income. So what about the non-operating cost? One of the sum of the non-operating cost will go into some of these items here. One component will be interest income and one component will be interest expense. And the rest of the non-operating expense will go into one of these items, restructuring charges. You might rename it as non-operating expense or special items. But on the accountant's P&L, let me show you again. We have a sum of all of the costs of the company in the financial year. That will be the sum of cost of sales, branch expenses, administration expenses, and financing cost. We don't worry about income expense for now. So if you sum up these costs, they tend to be the total cost of the company. And this can be divided into operating cost and non-operating cost. Okay, from reading the notes, at least we can identify non-operating cost of interest expense of $230 million. And if you go to read other notes, you might identify other non-operating costs as well. So given a total number of total cost of the company, and we have an estimate of non-operating cost, for example, $250 million, we can come up with an estimate of operating cost which is different from any of the cost numbers here. Are you with me on the thinking of the understanding of the cost? So you'll find it's difficult for you to go to the details of these cost items to decide if it's not operating or non-operating. So we come up with a solution to get around this difficulty and the availability of data problem. We have the end result of the profit, $1.5 billion. And we have an estimate of operating revenue, and we have an estimate of non-operating revenue, and we have an estimate of non-operating expense, which is mostly interest expense. And then you can estimate the operating expense from these numbers just by rearranging the items in the equation. Does it make sense?
So
yes.
Expense is the only non-operating expense we're looking at?
My message is that it's difficult to come up with an estimate of operating expense, but non-operating expense is easier to estimate, especially from the notes of P&L. For now, interest expense probably will be the main cost items for the non-operating assets. So if you use the operating revenue, minus operating cost, that's what you are trying to figure out, minus the non-operating cost plus non-operating income will equal to this number here. In that equation, operating revenue is easy to estimate. Non-operating income is straightforward. Non-operating expense is straightforward, and you have the right-hand side number of the equation, the profit. So from that equation, you can estimate the operating expense for the company as a single number, which is different from any of the numbers here. Because with this reporting of expenses, we don't know they are operating or non-operating. Does it make sense? This is how you can work around with the available information or data from the annual report to facilitate our valuation. Any questions? Yes? Anything? No? Yes?
Could you be able to repeat what you said about when you find the operating expense, you said find operating revenue, take away operating cost of sales, take away operating income, or you said something like that, and then we can, you know, we have the right-hand side, we have the profit and loss, and we should be able to figure it out. Could you be able to repeat that?
I'll probably write down the formula because I'm going to be away from the Mac and so basically, this is the equation that I was talking about. With the operating revenue, it's quite straightforward. You can estimate from the segment reporting, or just from here, you'll find most of these will be most likely to be operating assets. That's easy to estimate. And also non-operating revenue as well. We just identified dividend and interest income as non-operating income. If there's anything else, you will find other revenue here. If it's not included in the notes, other revenue, we classify this as non-operating. So we got this one. That's the tricky one, operating expense. But it's so important to calculate performance ratios, to calculate the ROIC as well and profit margin, and it's important for us to understand its performance, efficiency, and forecasting. We have to come up with an accurate estimate of the operating expense. With the non-operating expense, we have the major items of interest income. Maybe there's other things, but they are kind of trivial. And we have that as well. And we have the profit, as reported here, $1.5 billion. So if you rearrange this equation, you can calculate the non-operating, we can calculate the operating expense. The accountant doesn't report operating expense for us, like in a very good structure like cost of goods sold, sales, marketing, and other administration cost. If you take the sum over here, that might be not a big problem for Woolies, but for companies with a very messy cost structure and reporting, you will find it there will large discrepancy of doing the operating expense this way or calculating the sum of a few cost items from their financial report. It's still the ideas of your learning. So I prefer you do it in this way so that in the future when you're given a tricky company, you still know how you may get around the data problems here. Hopefully this will solve much of your confusion. Next one. We'll talk about the income tax probably next week. Tax can be quite tricky for valuation purpose. like we discussed in lecture, we prefer the cash tax paid to input into the NOPLAT valuation model. So next item will be the results from discontinued operation. So that will go into one of the non-operating incomes or special items. I'll show you. There are a few items. You might choose the location, choose an item like special item, or even you might rename 21 to discontinued operation to record the $111 million results from the disposed business units as non-operating income. The next one, the non-controlling interest. If you do not have a good accounting background, it might be difficult for you to understand what's non-controlling interest. So companies like Woolworths, it's not a standalone company. It got joint ventures, fully controlled subsidiaries, partially controlled subsidiaries, or equity investment, like they hold 5%, 15%, 20% of other companies. And in the past, they were involved in merger acquisitions as well. It's usually recorded as a non-controlling interest by the minority shareholders of the company controlled by Woolworths. For instance, that's usually the case if Woolworths, the company group, purchased another company of its 90% of shares outstanding. The minority shareholders of that company still holds the other 10%, but the company, the whole P&L and balance sheet will be consolidated into Woolworths annual report, into the numbers here. So in other words, Woolworths will report some of the assets or income actually should be attributable to the minority shareholders of the newly acquired subsidiary, but in their control. So that represents the total profit of the company group of $1.59 billion will be divided into two buckets. One bucket belongs to the shareholders of Woolies. The other smaller bucket belongs to the minority shareholders of this newly acquired subsidiary, but controlled by Woolworths. Because following the accounting standards, up to a certain level of control, this subsidiary can be fully consolidated into their reporting. The accounting standards on this has changed, and it might be different in different countries. So if going to value a company in another country, you probably want to understand how this consolidation is done, like as a background learning. So what you should try to input or come up with in your KGW model is actually this number, $1.533 billion for that line. Earnings for common shareholders. That should be, for 2017, it should be $1.533 billion. In the KGW model, minority interest is reported here. So you might have to play with the numbers a little bit so that line 30, it's a formula. That line comes with a formula. So that row 30 will have the same number as reported in the annual report of this $1.533 billion. So this is how we might play with the numbers from the annual report. It looks like I don't have time to finish all of the rest of it. With the discontinued operation, it's a net result. In the KGW model, it's more likely to go into special item or even the extraordinary item, or non-operating income. If it's extraordinary item, it's after tax. If you decide to report the discontinued operation in special item, it's before tax. So if you have to do some adjustment, go to read the notes of the discontinued operation and adjust the tax from the $111 million to report over here. So maybe it's more straightforward, just report here, extraordinary items after tax. What's extraordinary items? They are very rare in the normal business of the company, and you do not expect this to happen again, or you do not expect this to reoccur every year or every few years. I'll give an example. We assume Woolies got 2 warehouses in Australia only, 2 warehouses, one in Queensland, one in ACT. Now, we know the natural disaster can damage these warehouses, especially in Queensland flood. And they happen to build a warehouse next to a river. So that's probably not very wise for the company to do, but they did this. So if they report a damage of the warehouse in Queensland by the flood, and we know that in the past 3 decades, we observed a flood damage the warehouse like every 2 or 3 years. And in the current financial year P&L, you're going to find a place for that flood damage for the warehouse. It's going to go into special item, or you rename this as flood damage or flood cost. It's not part of the operation, although sometimes the accountants might record this part of the operating expense, but it does not happen every day or even every year. So in the KGW model, given the nature of the flood damage, it should go into the special item or the flood damage. It's a very specific item for the flood damage to the warehouse in Queensland, which is next to a river. So for the other warehouse in ACT, and we were just so unlucky, there was an earthquake. The whole warehouse was wiped off. Given the nature of the event, should it go to special item or earthquake damage or extraordinary item? Maybe the line 27, extraordinary item, will be more appropriate to record the earthquake damage to the other warehouse in ACT, because we do not expect an earthquake to happen in the inland of Australia at this that level of damage. So this is how you might decide, understand the nature of that event and the impact on the company's activities, and then decide how it might affect your valuation, the KGW model. These items will play their own role in terms of valuation. You got to find out yourself, see how these items will feed into your valuation and being represented in the results spreadsheet. I should stop here now. We'll talk about the intangible assets next week to show you how intangible assets are so different. The accounting treatment will be different, and how we treat them from the valuation purpose are different. I still advise you to read the notes and have a look at the annual reports of the company. I'll let you know the assignment group allocation by end of this week, probably tomorrow, and we'll let you know the groups I would like to see next workshop. I would like to see you talk to me about how you understand the company business and its performance. Thank you very much.
like if you go back to the maybe it's even back to an example. If you go back to the first when it says explicitly says operating expenses, then underneath it just says expenses. Like from an interpretive that would say that okay, we took the purpose of the expenses, therefore that informs the latter provision of each expenses. It's just general, it's not operating expenses. We use some of those interpretatives.